All right, let's get right to it. There's a lot happening in the markets right now, and you want to know what really matters. Booyah! You're looking at the market chaos and asking, what's the deal with gold? With stocks swinging wildly and headlines screaming uncertainty, gold is suddenly the talk of the town. Right now, gold is holding steady after smashing record highs, nearly $3,800 an ounce this week. That's not just a number, it's a signal that something big is brewing beneath the surface. Some see this pause and panic, but that's not weakness, it's strength. When gold takes a breather after a run like this, it's often a sign of resilience, not retreat. Gold is consolidating, building a foundation for its next move. Think of it as the market catching its breath, gathering energy for what could be a major leap. Think of it like a champion boxer catching his breath before the next round. The smart players know that patience here can pay off big. Gold's up for its sixth straight week, a clear trend, not a fluke. That's a winning streak that's hard to ignore, especially when other assets are stumbling. This stability signals that smart money is still betting on bullion. Big investors, institutions, and even central banks are quietly adding to their gold reserves. In a world of uncertainty, gold is the ultimate insurance policy. When everything else feels risky, gold is the asset people trust to hold its value. The market is a tug-of-war, fear and greed, trade wars, and Fed policy. Every headline pulls prices in a new direction, but gold stands firm in the middle of the storm. This steady price is the calm in the eye of a financial hurricane. While everything else is swirling, gold is the anchor that keeps portfolios grounded. Don't be fooled by the flatness. Pressure is building beneath the surface. The longer gold holds steady, the bigger the potential move when it finally breaks out. We're waiting for the next catalyst, and there are plenty on the horizon. From inflation data to global conflicts, any spark could set off the next rally. The question isn't if gold will move, but when, and in which direction. Timing is everything, and the next chapter could be written any day now. So grab your notebook, tune out the noise, and let's break down what's shaping your money. Because understanding gold's next move could be the key to protecting and growing your wealth in these wild times. Let's talk about the elephant in the room, the one stomping through boardrooms and rattling markets everywhere. President Trump just announced a 100% tariff on all pharmaceutical imports, a move that's nothing short of a full-blown economic shock. This isn't just a headline, it's a seismic event that's sending tremors through every corner of the business world. This decision sends a shockwave through global supply chains, creating chaos for major companies and leaving executives scrambling to adapt. Pharmaceutical giants, logistics firms, and even small pharmacies are suddenly facing a new reality. When the market gets scared, it runs for cover, and that cover is gold. Investors are quick to abandon riskier assets, seeking the safety of something more reliable. This isn't just about pricier prescriptions, it's about risk. The cost of uncertainty is now being measured in every boardroom and pharmacy across the country. Wall Street hates unquantifiable risk, and a trade war is exactly that. The unpredictability makes it nearly impossible for investors to plan ahead. Investors dump risky assets and pile into safe havens like gold. It's a classic move. When the world feels unstable, gold feels like a rock. Gold becomes the market's bomb shelter, a place to hide when the financial world feels like it's under attack. The more uncertainty Trump injects into the system, the more attractive gold gets. Every new policy twist or tariff threat just adds fuel to the fire. Whether you agree with the policy or not, as an investor, you have to react to reality. Ignoring these changes isn't an option if you want to protect your portfolio. These tariffs are a giant wrench in the global economy, boosting gold's appeal as a universal store of value. Trade routes are disrupted, and uncertainty reigns. Gold doesn't have a CEO, a supply chain, or earnings reports. It's timeless. It's immune to boardroom drama and political headlines. In moments of extreme stress, gold shines brightest. It's the asset people trust when everything else feels shaky. As long as uncertainty continues, expect a strong bid for gold. The more unpredictable the world, the more investors want in. The pharmaceutical tariff is just the latest chapter in a long, unpredictable saga. Trade wars have a way of spiraling, and no one knows where this one will end. Gold is the market's flight to safety, plain and simple. In a world full of surprises, it's the one thing investors can count on to hold its value. Let's dig deeper. A tariff this big doesn't just hit one industry, it ripples across the entire market. Pharmaceutical stocks get volatile, but so do shipping, logistics, and chemical companies. Every link in the chain is under stress, spooking investors. This is where gold's role as a portfolio diversifier is critical. When stocks drop on trade war fears, gold cushions the blow. It's not about perfect timing, it's about resilience. Aggressive trade policies create geopolitical tension, not just economic headaches. Other countries retaliate, escalate, and add global instability. Central banks get nervous and buy gold, diversifying away from the US dollar. So when you see a new tariff, think about the chain reaction. It's a cascade of uncertainty that undermines confidence in paper assets. Gold is the ultimate anti-uncertainty asset, your financial life raft. The more waves the trade war creates, the more people scramble for gold. That's why gold prices are holding firm despite other pressures. Now let's switch gears. Tariffs are the fear factor. Now let's talk numbers. Today, we get the PCE price index, the Fed's favorite inflation gauge. The market expects inflation to stay hot and stubbornly high. If the numbers confirm this, the Fed's in a tight spot. Its inflation fight isn't over. Why does this matter for gold? Because gold is a classic inflation hedge. When dollars lose value, you want a hard asset. High inflation is a long-term positive for gold demand. But here's the twist. High inflation means the Fed keeps rates high, which is a headwind for gold. Gold doesn't pay interest, so high rates make it less attractive. This is the tension. Inflation supports gold, but high rates hold it back. The market is waiting to see which force wins. Let's break down what the PCE report could mean for your money and investments. Scenario 1, hotter than expected inflation. This is when the numbers come in above forecasts, signaling that prices are rising faster than the market hoped. In this case, bond yields spike as investors demand higher returns. The dollar jumps as confidence in U.S. assets grows, and gold may dip in the short term as traders seek quick liquidity. But a hot number also raises the risk of a recession down the road, eventually sending investors back to gold for safety as uncertainty grows and risk appetite fades. Scenario 2. Numbers come in as expected. Inflation remains sticky and high, not budging much from previous months. The stalemate continues, with gold trading in a range. This is a period where prices are relatively stable, giving investors a chance to accumulate gold at consistent levels, without the fear of sudden swings. Scenario 3. Cooler than expected inflation. If inflation cools more than anticipated, the Fed could cut rates sooner than planned. Bond yields and the dollar would likely fall, and gold could rally sharply as investors seek assets that benefit from lower rates. This is the Goldilocks scenario for gold bulls. Everything lines up perfectly. But in today's environment, it's also the least likely outcome. The key takeaway: don't just react to the first move. Think about the long-term dance between inflation, interest rates, and gold prices. Markets can be volatile, but trends play out over months and years. Each scenario has a different impact on your portfolio, but gold's role as a hedge against uncertainty and inflation remains strong. The market's next move depends on which scenario plays out and how investors interpret the data in the days that follow. Stay nimble, watch the data closely, and remember, gold thrives on uncertainty, often shining brightest when the outlook is unclear. Use these moments to build or adjust your position, taking advantage of volatility to strengthen your long-term strategy. The PCE report is a catalyst, a spark that can move markets, but it's not the whole story. Other factors will shape gold's path. Gold's long-term case is bigger than any single number. It's about protection, diversification, and building wealth over time. Let's step into Jerome Powell's shoes. He's balancing persistent inflation against a fragile economy. Cut rates too soon, and inflation roars back. Keep them high and risk a recession. Recent data shows a strong economy and sticky inflation. No reason for the Fed to cut rates yet. This is why gold can't break above $3,800. Powell's public statements are calculated ambiguity. He wants options open. The Fed's uncertainty is actually a support for gold. When the world's top central banker admits he's unsure, investors get nervous. That nervousness drives demand for gold's safety. Higher rates are a headwind, but Fed uncertainty is a tailwind. The market's tug-of-war. Can the Fed engineer a soft landing, or will something break? History says soft landings are rare. When things break, gold shines. Now, Trump versus Powell, the battle for interest rates. Trump is publicly pressuring the Fed to slash rates to 2%. Powell resists, defending the Fed's independence. This political drama adds another layer of uncertainty. It politicizes monetary policy, making markets uneasy. Will the Fed overcompensate to prove independence or cave to pressure? Eroding confidence in institutions drives investors to gold. Trump's attacks, ironically, are bullish for gold. More chaos, more demand. Every tweet is another reason to own the one asset outside the political system. Let's talk about gold's arch-rival, the US dollar. When the dollar rises, gold usually falls because gold is priced in dollars. A stronger dollar makes gold pricier for foreign buyers, dampening demand. Lately, the dollar's rebounded on expectations of higher for longer Fed rates. This is a key reason gold's rally has stalled. Watch the dollar index. If it weakens, gold could surge again. What could weaken the dollar? Soft inflation data, Fed worries, or trade war escalation. The dollar's current strength is based on US resilience and hawkish Fed policy. But long-term, massive debt, inflation, and instability argue for a weaker dollar. A weaker dollar is a powerful tailwind for gold. The current dollar rebound is a temporary gust, not a lasting trend. For gold, the real weather pattern is still bullish. Let's bring it home, your gold game plan for 2025. Gold is steady at high levels for a reason. It's caught between powerful forces. On one side, fear from tariffs, inflation hedging, and political chaos, all pushing gold higher. On the other, high interest rates and a strong dollar, keeping a lid on prices. The market is coiling, building tension for the next big move. Don't try to time it perfectly. Focus on fundamentals. The world is more uncertain, inflation is stubborn, and policy mistakes are a real risk. These are long-term reasons to own gold. Use this consolidation to build a position. Don't go all in, scale in. If you already own gold, hold tight. Ignore the short-term noise. The forces of fear and currency debasement are rising. The tide is moving in one direction, lifting the golden boat. Don't miss the ride. Gold's story isn't over. It's just getting started. Booyah!